And Francisco, the other message to come out of Brussels has been a threat to Putin, or at least, strengthening the NATO alliance in case Putin uses biological, chemical, or nuclear warfare. That is not a 0% probability. How would the market react to any escalation like that?
Well, look, I think the oil market obviously would be very concerned upon that kind of escalation because the threat of sanctions on energy could potentially materialize if the conflict were to escalate. So I think that the direct consequence would be potentially some sanctions on energy, which, as you know, Europe has been avoiding so far because of the risks to the European economy and European consumers.
So what's priced into oil at this point? We're down 3.25%, but still above 110 on the price of WTI. How long is the market expecting these Russian barrels to be offline? And what does it expect as far as potential further sanctions?
Well, I think the market is pricing in a scenario which is our baseline scenario, what we call the bad scenario, that we'll probably lose about 1 million barrels a day of Russian supplies throughout this year. And also, we're looking at potentially some relocation of Russian barrels away from Europe and the U.S. into India and China. That's what's been priced in. But I don't think the market is pricing in a major disruption beyond 1 million barrels a day. There are scenarios, which is our ugly scenario, that if supplies were to drop by 4 million barrels a day from Russia, remember Russia exports about 8 million barrels a day in a 100 million barrel a day market, we could see prices potentially rising by $60 to $75 a barrel on top of the current levels, scratching $200 a barrel. Again, that would be a scenario where Europe would be actively trying to block Russian barrels into their economy. A difficult one to see, but one that could happen under an escalation of the war in the Ukraine.